Alright guys, so let's talk about our best friend today. Scott Bessent is back in the headlines and this time he's trying to calm everyone down with regards to China. But we know the truth. He's in panic mode deep down because he needs to sell the US economy that a permanent China deal is coming. The US economy desperately needs this win. Now, according to Bessent, talks between the world's largest economies are in a very good place ahead of the meeting in the coming weeks. But let's get real here. Talks between China and the US are rarely tension free. Both sides wants to checkmate the other, and it's very likely Trump will have to push back the deadline. And if he does that, it's basically a win for China. It will show Bessent has more buck than bite, and we have a litany of tariffs stacking up for the US economy already. We have copper, aluminum, and steel tariffs, all vital inputs that are putting extreme pressure on US manufacturing. And don't take our word for it, the numbers are already reflecting the weakness in real time. Now, despite the talk of restoring US manufacturing jobs, the figures are actually heading down. The downtrend from the Biden administration is still in a strong downtrend. Now, in May, manufacturing hires plunged to an 8-year low of just 280,000 workers. The double whammy of US consumption plunging and the drop in exports is happening. And this means Bessent just can't afford for things to go wrong with the China talks. A lot of these goods are not just toys in Walmart or furniture at Home Depot. We are talking about intermediate goods US companies themselves need. So we can expect Bessent to tiptoe around the talks when he meets the Chinese trade team. And that's probably going to be Hurley Feng. Maybe even Lutnick will come along because the stakes will be high. Now, in the Bloomberg interview, Bessent basically sold everyone the dream, and it's a really beautiful dream. That the stock market is up because of Trump's deal making, that the trade deals are net positive, and that's why US stocks are going up. But not if the coming Chinese trade deal falls apart. Now, the majority of US imports from China are in computers, electronics, and electrical equipment plus components. And if we throw in chemicals, machinery, and metals, more than 60% are mixture of consumer and industrial inputs. So should a trade deal collapse or impasse happens, we could see a situation where consumer inflation spikes up again. Plus, US manufacturing will continue to contract for many more months to come. And that would take down not just the stock market, but the bond market as well. So all eyes should be focused on China. Now, the problem with Washington is supply chains. They didn't do enough to build networks around the world, especially across Latin America, Africa, and of course, Russia. US domestic supply also isn't enough, so everything imported will be subjected to brutal tariffs of 30 to 50%. And even now, Lutnick is using the defense argument to protect the tariff regime.
And all you do is import aluminum, and all you do is import copper, how are you going to fight a war? We need steel to be made domestically. And so Donald Trump is saying, I'm going to take that government subsidy off the table. I'm going to put tariffs in to make it equal so Americans build steel here so that if we want to fight a war, we can make our own ships, our own missiles. And that's the key to Donald Trump's thinking.
Now, the challenge now is pressuring China to make a deal. Firstly, there are two problems with this. Chinese exports, as we said previously, are still strong. The world is still buying them to counter Trump's tariffs, so there's no issue with selling goods to the world. And secondly, China still hasn't activated domestic consumption yet, and this is the sleeping dragon still waiting to be awakened. And there are two ways of looking at the chart. China's GDP deflator has been negative for the last 9 quarters. In other words, prices across the board are still weak. And this might be bad for companies, but it's good for local Chinese consumers, which means the central government still has room left to stimulate the economy. Retail sales have grown by 4.8%, while industrial output is up by 6.8%. So there is a big gap between them. And if China manages to close that gap, it's game over for Bessent because the leverage will swing towards the Chinese economy. The advantage China has is still their export-based manufacturing economy, and this allows them to weather all sorts of storms. It allows them to support the global economy during this tariff war. Now, Trump is giving the world a really raw deal, and his latest trade deal is a great example of how lopsided things have really become. More importantly, it's why countries have no choice but to keep trading with China. Indonesia just signed a really lopsided deal with the US, and the details are quite mind boggling. They will buy $15 billion in expensive US energy, and you throw in $4.5 billion worth of food products. They are also going to buy 50 Boeing jets, and for what? For the privilege of lowering the tariff rate down to 19%. That's still a crazy high rate when US exports are not getting tariffed themselves. So the tariff has dropped from 32% down to 19%. I guess that's good, but how else is Indonesia going to sell stuff to the US, especially value added products? They will have to import more from China to either lower their own production costs or to fight their own consumer inflation, which tells us how the US and China trade negotiations will end. Either a stalemate with Trump doing another taco or China taking the advantage. Let's shift focus a bit to the coming crisis for the dollar. And by now, there's a ton of speculation about Powell's replacement. And by hook or by crook, Powell will leave the Fed chair position in May 2026, that's next year, which means Trump will be able to install one of his henchmen as Fed chair. And we all know what that means. Interest rates are going to fall all the way down to 1%, maybe even lower. Now, all the candidates we see here, Bessent, Kevin, Waller, and Bessent, they're all doves. They will drive down interest rates in a heartbeat the moment they take over Powell's position. But if this happens, really understand what's going to happen to the dollar, especially amid a trade war. You cannot expect a rebound in a currency when US trade is dropping and interest rates are about to fall. It's critical we understand the two key drivers of US dollar strength and why destiny itself is going to send it down lower, especially if Trump executes his grand plan to kick Powell out. Firstly, the US trade deficit is not recovering yet. Sure, they are importing less from the world, but that's because of the tariffs, and in the same breath, US exports are dropping at the same time. In fact, the trade deficit for May hit nearly $100 billion, and that's a 10% increase from April. The bigger the deficit in the current account, the more negative it gets for the dollar. Another big driver is the net foreign purchase of US debt. Demand for treasuries and assets is a big driver for dollar strength. The fact that the dollar is dropping tells us a lot. So, what happens when Trump decides to replace Powell with one of the dream team? And doesn't matter if it's Bessent or Hassett, interest rates will come down, which means yields on future bond issuance will drop, especially on the short end. So now you have the specter of higher inflation looming while US debt is giving a lower rate of return. Does this make investors really that stoked to buy US paper considering everything else? Well, no, it doesn't. And that's why the new Fed chair is really a big event. It's a good sign that the dollar's plunge isn't over just yet. And we have to position ourselves really carefully here. We are at the beginning of a dangerous structural shift that can only reverse if the trade war does a U turn, which in all seriousness it simply won't. Trump is too invested in this direction to simply give up. Now, we can see this really clearly when we observe the relationship between global stocks and the dollar. Now, before 2025, the relationship was clear. If global equities rise, the dollar would fall as a result. And if global stocks crash, money would flow into the reserve currency as a safe haven. But Trump's trade war changed everything. Now, in March and April, when global stocks are down, the dollar is also collapsing. The correlation has gone haywire and it confirms what we are all afraid of. US trade policy is turning the entire game on its head, and that's why following the old rules don't matter anymore. Everything is being controlled, being puppeted by Emperor Palpatine, and he has turned the US consumer market into his own personal Death Star. However, it's not really working that well. Many countries see this and they can see the writing on the wall. When the US starts to push hard, even traditional allies and friends will move to the only other alternative, and that will be China. The Australians are now in China looking to talk trade. Suddenly, all the animosity and all the old disagreements have melted away, which is really quite funny. Albanese met with President Xi in Beijing. He even went to the Great Wall of China, so he's really paying his respects there. And if we look at the readout, we can tell that Australia is trying to hedge their bets. China is a big trading partner and they buy a ton of Australian commodities. Albanese isn't on a holiday tour, he is visiting his biggest customer. Now, China is overwhelmingly by far the largest trading partner that Australia has. It is very much in the interest of Australian jobs and the Australian economy to have a positive and constructive relationship. Now, this sounds like a Captain Obvious statement, but when you have the US breathing down your neck with tariffs, suddenly the urgency to hedge with China goes through the roof. And if China and BRICS are going to be the new growth engines of the world, it's obvious where you want to place your bets. When Trump starts slapping the world with commodity tariffs, sooner or later, the US market will close up on you. China imports four main things from Australia: iron ore, natural gas, gold, and agricultural products. The Chinese middle class is going to explode over the next decade, which means consumption power is going to skyrocket. Australian mining alone is around 9 to 10% of the country's entire GDP. And the last thing you want is for China to ignore your exports because you know you sure as hell can't sell to the US markets that easily anymore. Now, Australia has made terrible mistakes, especially with the AUKUS submarines, but at least they aren't doubling down on this madness. Now, to be frank, that sounds ridiculous, right? They are buying nuclear subs from Trump, who's punishing their economy to guard against China, which is their biggest trading partner. And that's why I can't take geopolitics and economics seriously anymore. It's an upside down world. But as always, there are no permanent allies, only permanent interests. Now, Australia is one of the few countries in the world that runs a persistent trade surplus with China. In other words, China runs a big trade deficit of $10 to $20 billion with Australia. Australians are earning money from Chinese trade. They are selling more to China than what they buy from Beijing. Plus, Albanese probably knows China is building new mines and supply chains around the world, and this makes Australian goods an option and not a necessity. And the last thing he can afford is for China to just play within their own supply chains. So this trip is highly pragmatic, and we can expect more countries around the world, even the ones closest to the US, to slowly peel away. Australia is going to be one of many more to come. But as always, let me know what you think. Will Bessent close a good deal with China? And will the dollar continue crashing even lower? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.